Cash rent. Are you paying too much? Charging too little? That's the topic of this episode of The Business of Agriculture. Hey, Damian Mason here with a question before we hop into this episode of The Business of Agriculture. If you farm for a living, you employ a lot of amazing technology, from your inputs that you put into the soil to the tractor that you sit in, your combine, and the amazing data that it harvests. But has your soil analytics kept up technologically with everything else in your farming operation? I would venture to say that no, it is not. Sure, you check for your nitrogen, your phosphorus, and potassium, your micronutrients as well. But what about disease pressure? Do you know what diseases and what pests you're going to face next year? No, you don't. But you can now figure that out with Pattern Ag's predictive analytics. Think about it. They can tell you now with testing what the likelihood of facing nasty diseases, things like cyst nematode or sudden death syndrome, what the likelihood of you having this in your field, then you know how to prepare, how to treat, and where to invest your money. It's using technology to make you bigger yields and therefore make you bigger money. Go to www.pattern.ag to learn more. They are pioneering the way in predictive agronomy. Hey there, welcome to another fantastic episode of The Business of Agriculture. I got Howard Halderman of Halderman Real Estate and Farm Management on to talk about cash rent. We're talking about the methodology. How should you calculate cash rent? How much should you be paying? Talking about the ways you derive a number that's fair to both the owner and the tenant. There's a lot going on here, and trust me, I travel all over North America, and one of the things that comes up, once you get done, you've done your speaking engagement, hey, let's go over here and have a beer. Hey, Damian, what's that farm ground where you live in Indiana renting for? Now, what's it sell for? People love to talk about land values. They love to talk about what cash rents are. I've got Howard on here because he and I, he's been on here 2 times before, but also I do a hosting job for the Halderman Quarterly Webinar, and we talk all about, he's very, very on top of marketplace trends in ag real estate, both in terms of sales and in terms of the rental rates. Now, is he an expert on almond groves in California? It's a little bit out of his wheelhouse. We're probably going to get there also. So it's an important asset. There's about, 360 million cropland acres that are devoted to food production. Of the 900 plus million farmland acres, only like 360, about 40% of them are actually producing the food, row crops, food crops, whatever. And of those, I've read the stat, about half of them are rented, if I'm not mistaken, and it's still a real cloudy picture. So that's what I want to do here, is dig into this topic and spread a little clarity about what the numbers are, what they should be, how they should be derived, and then also some of the methodology that you're seeing and doing in all this. So it's a big topic. Pick up where I just left you there, my friend.
Well, Damian, thank you for the opportunity to be a part of the business of agriculture. And you bring up the percentage. What percent is rented out? And it's somewhere between 30 and 40%, but it varies highly by state. So state of Michigan, which is one in our market territory, is going to be at the lower end of that range, whereas the state of Illinois is going to be 60+%. And so those are the acres that a farmer is farming, but they don't own. And so we call those absentee landowners. Those happen to be our clients at Halderman Management. And an absentee landowner is very simply somebody, they might live on the farm, but they just farm themselves. And so the question, if I'm a landowner, is, well, how best, what's the right rent? How do I calculate that? What's the right rental structure? Because historically, if you go back to the 1970s, we had a lot of 50-50 share leases where you paid half all the crop inputs and got half the crop as your rent. And if you made profit on that, that effectively was your net rent. That has transitioned over the last 30 plus years of my career to where we have a very high percentage, especially in the Eastern Corn Belt, of cash rent or cash flex leases. And a couple reasons for that, but I think one is just that it's simpler for the farmer and it's simpler for the landowner. And you'd say, well, gosh, that puts the farmer highly at risk. It does. They're going to pay, say, $300 an acre, average cash rent in Indiana. They're going to pay that $300 an acre, and if they don't produce anything, that's all money out the door, and it's a loss. That's true. But at the same time, the farmer is willing to look at a cash rent or a cash flex lease, because if you think about today's farmers, they're farming 4,000, 3,000, 4,000, 5,000 acres, and they're leasing that at 200 acres a pop from a landowner. That's a lot of landowners to deal with.
Yeah.
And so it is simpler for them rather than divide out 50% of the seed and 50% of the fertilizer for 30 different landowners. Well, I'll just pay them all cash rent, and that'll make my life simpler and easier to manage. And that's absolutely the case.
Yeah, so you just gave us a bunch of stuff, and I sent an outline to you. So about 40% on the national average. I thought that's what I'd read. You said it could be as low as 30% of the land that's farmed is rented. And there's people that still don't even understand this. You know, I'm out in Phoenix part of the time, and I bump into people, and they don't understand that a farmer might farm 4,000 acres and own 800 of it.
Right.
What have you. And then you explain to them that it's like renting a warehouse space if you're in the business of trucking, whatever that thing should be. It's just an asset that you use and pay rent on, and it has to make sense for both parties. You just said roughly you threw out the number $300 for an Indiana average. Is that a 2023 average that you see?
Yes, the Purdue survey would put the highest quality land in the state of Indiana at $306 an acre. Average quality land at $275. Mm-hmm. So that's kind of the range, and $300 is a pretty typical. It's a little bit lower in the state of Ohio, because I looked up the Ohio State numbers, and they were $288 for the best quality and $233 for the average quality.
288 and go down to what? 253 or 233 for the middle?
33 for the average quality. Indiana was 306 and 257. And then you go to Illinois, and they have a much more bifurcated and a lot of different types and geographic areas. But their high end, Damian, was over $400 an acre for their best quality. And their low end could go all the way down to, in the hundreds for below average land.
Yeah. Now, what's interesting is, Indiana's survey done by Purdue always does high, middle, low, and there's a spread, as you know. This has been your business your whole life. There's a big spread between one part of middle and another part of middle. One part of middle, and even that high. It seems to me that 306 is a little light when you start thinking, well, I know some pretty good ground that's certainly going to be above that average by, 50 to 60 or $80, I should think.
Well, that's a great point, Damian, because I've had landowners say, well, we just do our rent based on the Purdue average or the Ohio State average, whatever, land grant you want to pick.
Yep.
And you're going to make a mistake doing that, because every farm is unique. Yep. Different field sizes, shapes, location, fertility, soil types, drainage. And so what I just quoted were averages.
Yep.
We certainly have many rents higher than 306 stated. Yeah.
I want to get to the rent rate variability, but while we're just on trend, because you just gave 2023 numbers, is trend, I would think that trend looks like it's going to be flat, maybe down when we're predicting lower commodities. However, isn't it true that the rent rate usually takes a couple years of ag economy downturn before it adjusts downward? In other words, it's lagging as an indicator, if I'm not mistaken.
Yeah, you're absolutely correct. In fact, in our seminars, I use a chart, and I have at the top cash rents lag economic returns. So they lag on the way up. They also lag on the way down. They also tend to be sticky. So they may not go up. They're not as volatile. You don't see it spike up when corn goes to $6. So they'll react a little more slowly. But then when the commodities start to turn, so your point about 2024, commodity prices start to edge off, farm incomes look like they'll be lower in 24, you'd say, well, rents ought to respond accordingly. Steady is going to be the response. And that's based upon the rents that we have negotiated. And we've had 4 or 5 farms that we've had bid out on a sealed bid basis. The farm manager doesn't make the market, Damian. The farmers make the market.
Yeah.
And so you've got 300 acres out for rent, and you get 14 different farmers bidding on it that submit written bids. And you analyze those versus where we were before, and steady is where we are. I thought I read in a couple surveys in Iowa and Illinois, maybe steady to slightly down, 1 or 2%. So not a lot of change. So they're sticky, they'll stay up, but they can go down, and they certainly did back in 2014 and 15. A similar decline in income.
rent rate variability, and I'm going to make sure my friend in Ohio, he's from Southern Ohio, and his family has farm ground down there, and he likes to dial into your stuff when you and I do our webinars, which is great. He's a Purdue guy. Variability, and they always ask me, well, what should it be? And I said, man, first off, I'm not the expert. Talk to Halderman, they're the experts. But secondly, there's a hell of a lot of variability, and it could be from township to township. It could be from the competitive nature. So there's real factors, and then there's factors that don't have as much basis in fact, I guess I should say, or basis in viable reason. So speak to some of that variability. When I wrote this outline and kicked it your way, I said, you got things like productivity and location and size of the plot. That's a real simple one right there. So going through each of those cause variability. Productivity is probably the biggest one, right?
Yeah, soil type is going to be your leading indicator. That's the one that all the soils are mapped and they're rated on their ability to produce corn. And so a Brookston soil is going to be better than a Miami soil. Yeah. And it's going to have more organic matter. It's just going to be more productive. However, you're right. There are other factors. So location, what's the proximity to a ethanol plant or to a grain buying location? Is it on a hard surface road or a gravel road? Is it at a dead-end road or is it out on a major highway? Is it located? Is that farm located? You can have the best farm in the world, but if it's located in a generally below average agricultural area, it's not going to rent as well as what it might in some other location. So location is a huge factor. A bigger one today than ever before is size and field shape. Today's farm equipment is much larger than ever before. 24-row planters. I could comment on these being hassle farms. So imagine an 80 acres that's a half mile deep and a quarter mile wide. And if it was just one field, that's pretty efficient to farm. You pull in, down and back, down and back, down and back, done, and you're on to the next one. Versus an 80 acres in 5 fields because there's a creek running through it and a couple patches of woods. The farmer's going to look at that with today's equipment and say, yeah, I don't really even want to farm it because it's so hard to do. And so you're probably narrowing your market down for potential tenants to those guys that have smaller field or equipment. And at the same time, you're going to get a lesser rent probably because it is more of a hassle and moving around and setting up. So all those factors come in. Drainage is a huge issue. You could have the best soils out there, but if they're not properly drained and you always have a yield drag because it's too wet, then that's going to be a knock on the rental value.
Yeah. So when I wrote down other factors, then size, like you said, it was even an issue, in the 1970s, okay, I don't really want to fool with this 4.5 acre patch over here. Right. Those became and when a lot of people had livestock, the infamous 4 acre patch, it couldn't get any bigger because it had a landowner, a homeowner on one side and a creek behind it, whatever. Those became small hay fields. And now there's less livestock in the countryside on a small scale basis. They kind of became thickets or home sites, really. That's we've been seeing this for a while. What about the other factor, Howard, about goes right down to the competition in an area? You're in the auction business. It only takes two to make a good auction. Isn't it kind of the same thing on land values and rent rates? If a 5,000 acre farmer here to my right and 5,000 acre farmer to my left, they both have expansion mindsets, my rent's probably going to be pretty good.
You're exactly right. And competition and really the long-term success of agriculture in an area is a huge factor. And if you're in an area where there are many successful farmers and they didn't have a lot of financial problems in the 1980s, and I can cite a specific county here in Indiana where south of town had a couple of large farm operations that were in the 1970s, heavily row crop based. Had some struggles as they got into the 1980s. North of town had more confinement swine operations. And you might have heard over the years, Damian, that a confinement fair to finish hog operation was a mortgage lifter.
Yeah, right.
Well, that was true because in the 1980s, if you had pigs, you probably survived.
Yeah.
And north of this town, there were more of those operations. And so financially, north of town was a little stronger than south in the 1990s. And so rents and land values were skewed, even though geographically, they were the same. Soils, they were the same. Climate patterns, the same.
Yep.
And so the financial success of farm operations in a geographic area is certainly a factor. And as you described, if you've got those two large operations, I don't want people to walk away from this thinking that we exclude the young farmer, the beginning farmer that wants to get started. Trust me that we have a lot of landowners that have a passion for the next generation. Now, those large 5,000 acre farm operations very likely have a younger generation in them.
Yeah.
And so you kind of gotta match that up, but competition is a huge factor.
What about also not just competition? The other thing is, it used to be, oh, well, it's because those people are next door. This farm machinery goes 35 miles per hour and it can cover a hell of a lot of acres when it gets where it's going. There is still this mindset that the person that's going to rent it has to be within 3 miles away, and that's completely inaccurate. Your operator could be in the next county, and that's happening more, I think, but you're the one that sees it all the time.
That's true. There are more farmers that are going over a multi-county area and a bigger geographic spread. There are other operators that prefer not to do that. They say, if it gets to 5 miles radius from my headquarters, that's my limit. Other people will go maybe 10 or 15.
Yeah.
As a manager, I'm looking at bids. And if I've got a bid from somebody who's a couple miles down the road versus somebody who's 20 miles away, and they're the same, I'm probably going to lean to more the local person, simply because if I want my roadsides mowed, if I want a little more loving care done, I'm a landowner and maybe I want snowplow for winter.
Yep.
That guy that's right down the road is my neighbor.
Yeah.
And there's more neighborhood activities that maybe I get the benefit of. And I'm not disparaging somebody from 15 miles away. They can certainly do a great job, and they mow roadsides and they do all that too. But sometimes that local presence, because they're in the community that you live in, that you're part of, might get a little more weighting.
Yeah, and those are sort of intangibles that is it worth money? Well, it kind of is, and so then then it becomes. The rent rate is the rent rate, but because you are nearer, and we think that gives us a little bit more care, a little bit more attention, a little bit more attentiveness. All right, I want to talk about the infamous old widow story. Before I do, I want to tell my listeners and my viewers about my new sponsor, Redox Bionutrients. Redox Bionutrients is, yes, they are in the bio space, but they're not a new biological company funded by a bunch of tech venture capital coming out of the Bay Area. They've been around for 30 years. Redox Bionutrients is headquartered in Burley, Idaho. Darren Moon started this company 30 years ago. He said, I think there's a better way. He's been doing this for 30 years. They have a division in ag, and they have a division in turf. So again, don't be cautious and saying, oh, God, you can't trust them. They're another one of those biologicals. They've been around for 3 decades. That's why I accepted them as a sponsor here at the Business of Agriculture. Give them a shot. More importantly, just check it out. I don't mind if you're skeptical. I was too. 30 years of proven in-field success. Redox is helping farmers shift from traditional fertilizers to carbon-based technology. Redox provides superior nutrition, abiotic stress defense, root growth, soil health, and also their products aid in efficient nutrient uptake. That's the whole entire match right there. That's what we're talking about. You can go and check out redoxgrows.com. They've got a Redox Grows podcast. I was one of their guests. You can check that out. Also, redoxgrows.com. Again, I think that they would agree with me. The CEO and I were on a past episode. It's okay to be skeptical. There's a lot of this stuff out here. These guys have been around for 3 decades. It probably must be doing something right. Check it out, redoxgrows.com. The infamous old widow story. You'd say it's infamous because it's real. I bought a chunk of ground, just a little chunk of ground. I had a little bit of money I had to do something with, and I've known this woman since I was a 14-year-old. And the guy that was operating her land wanted to rent it. And I said, what are you paying? He told me, and I said, we're not going to do business together. Take advantage of this 70-year-old woman because she doesn't know what they're... And I think that's really where a lot of these people get it wrong. And there's going to be some of my listeners say, you sound like you're being anti-farmer. You should get as cheap as you want. You're not going to retain it. If you're screwing somebody and you're paying 60% of what the market price should be, you're probably going to lose that property in this era. But you tell me.
You're exactly right. I think in any business, whether it's agriculture or any business, if you're taking advantage of one side of a transaction, that's probably not a long-term arrangement. So when we manage a farm property, I want to accomplish two goals, Damian. One is to maximize in a fair way current income, but I don't do it at the disadvantage to the second goal. And the second goal is to enhance the value of the farm long-term.
Yep.
Because your return is two components. It's cash yield plus the value appreciation. So I'm looking for a long-term relationship. If you have a revolving door of tenants, meaning that you're changing them every year and you're just seeking the highest dollar, you're over time probably going to see the quality of that farm erode. Versus when we rent a farm, and I just commented earlier that we had a couple bid situations this winter. The intent there is we find a new tenant, and that tenant's going to be there for 10 years, 20 years.
Yeah.
Long-term, multi-generational, because then they invest in the farm. They help take care of the farm. It becomes more valuable over time. And at the same time, they're paying a fair market rent. I don't say top of the market rent, Damian. I say fair market rent. The tenant needs to be profitable.
Yep.
So we appreciate that they need to make money.
Yep.
But at the same time, if they're taking advantage of somebody, and in your example, that's probably not going to be a long-term solution for them. And so one of the tools we use is cash flex leasing. And maybe this is a transition in that discussion, but in a cash flex lease, you have a base rent that's below top of the market fixed rent. So a little less risk on the front end for the farmer. And then if it's a good year in terms of revenue, so yield plus price times price, if it's a good year, then that farmer pays a bonus. The landowner earns a bonus.
Yep. And
it's representative of 2024. It's not based off 23. It's not based off 25. It's what happens in 24.
Yep.
And sure, in 2022, you're talking about one of the best farm income years in history. And you go back to 1973 to find a similar year.
Right.
So there were some really big bonuses paid, but it was a really good year on the farm. So we use a lot of that cash flex leasing because that kind of helps smooth out the rent over time. And it rewards the landowner in years where they should be rewarded because it was a good year in terms of yield and or price.
So the fair, and I don't want to, it seems to me you were a pioneer. Your company was a pioneer in this because first off, there was 50-50. There was pure shares. There was even a 1/3, 2/3 arrangement.
Yes.
Sometimes I got a friend in the South, extreme ag guy, Matt Miles, they still do, everything's on a share. And he points that out, not as much anymore. And he said, that's why all these landlords always wanted me to grow cotton because that was where they got more dollars off of their share. So we don't really see sharecropping in the Midwest, at least not the Midwest that you and I are familiar with. I don't know, maybe when you get into the Dakotas, maybe, but I don't think that happens there either. It seems to me it's not
more
really...
pure leases. I think the Illinois Professional Farm Managers Survey would show 26-30% share leases in Illinois. And that's more common as you go west.
Yeah.
So it's still part of the landscape, but it's a lot lower percentage than it's been in decades.
So whether or not you were the pioneer, the originator of it, certainly you were early on. I remember, you were doing these sort of flex or hybrid sort of arrangements, if you will. And that seems like it's the, fair. I always say, you and I have been in business for our whole lives here. Fair, and people say that ain't fair. That ain't fair. I'm like, fair is a place where you eat cotton candy and they give purple ribbons to pigs. Okay, that should never be. There's no such thing as fair. But then we both have an idea of what is right when it comes to business. There's an idea like, oh, I'm gonna get ahead by screwing people. I think if you're paying 40% less than you should to some older landlord because she or he doesn't know what's going on, I cheer that somebody's going to come along and take that away from you and do the right thing because we know what's right. And that's where I like the flex base because in a year we're seeing some downturn in the commodity values, there's probably a little bit of a reluctance to go big, but you don't have to. You go with this rate and then it's based on profitability and yield, right?
Exactly. And we've been doing it since 1997.
Yeah.
So long time. And I can remember years that the bonus paid on corn or it paid on wheat, didn't pay on the other commodities.
Right.
And so it's commodity specific. It is a negotiated item with the tenant. And again, it's trying to accomplish what I said earlier. We want the farmer to be profitable, but we also want our landlord to make sure they're getting a competitive rent. And if we accomplish those two things, then the value of that farm property is also going to go up over time.
How should rent rates? Okay, the flex method that you do a lot of and your management systems is a really good one. But if a buyer, let's say I buy a chunk of ground and I say I want you to manage it, but you know what? I right now can't do the flex thing. And I'll tell you why. I'm a little skinny on this. My payment is this. And for me to make sure that I got my payment set, I need a guarantee on that cash rent. That's very understandable, I would think, from some investor that approaches you. Yes. So then how do you tell them you're going to structure it? Just by pure bid?
Generally, that's the way we would do it, unless, of course, the farmer brought us the deal and that investor bought it. We try to honor that relationship and go back to the farmer that brought it to us. But honestly, Damian, they're going to probably give us a bid on the front end before we even buy the farm so that we know what the rate of return is going to be. One way to calculate it would be on soil productivity. Yeah. And we talk about this a lot on land values. We use the weighted average productivity of the soils. Each state has their own way of doing it. CSR, corn suitability grading in Iowa. Illinois has their so many bushels per soil type acre, and Indiana has theirs. Those are, you don't want to really commingle them because Illinois are on a different way of doing it than Indiana is. But within that state, you can take the sale price and divide it by that productivity index of the average of the soils on the farm and come up with so many dollars per bushel of value. And today that's trading somewhere around $85 per bushel of productivity index for a land value. Well, so you asked me the question, what would that be for rent? And I did some calculations and I kept on the Purdue averages, and I was coming around $1.80 per bushel.
So you came up with a rent, and this is an average?
Yes, sir. So I'm using the Purdue averages, so $306 a bushel on 221 bushels per acre.
Wait, you just said $306 bushel. $306 per acre of cash rent. So then backing that out against the productivity yields.
The productivity, which their average was 221 bushels. Mm-hmm. So $306 an acre rent divided by 221 bushels, that's around $1.80.
Okay.
If you do the math on the average, the 257 divided by, I forget what the yield was on that, 175 maybe, you come up with the same kind of calculation. So if your productivity index is 150 bushels to the acre, you're going to get, I'm not quick with math, at 8/10 of 150.
150 times 1.8, is that what you're saying?
Yep.
So 150 times 1.8 puts you at $270 of cash rent.
Go.
Okay.
And that's a way of doing it. Now, odds are high that might rent for more than that because we said earlier, these Purdue numbers are averages.
Yeah.
And so that 270 is probably going to be the low end of the range, but it gets you in the range.
I've always been suspect that you and I both keep up. Obviously, we both went to Purdue. I keep up with Purdue's survey, and I keep up with Iowa State's. I think I have read the University of Illinois as well, but I always read it, and I think there's still some fudge to be ciphered through, because if some of these numbers are reported by farmers, I'm convinced that they don't put real numbers out for fear that it means that they're going to end up having to bid up more pricing. And I've been told, no, it's people like Halderman, it's people like the farmers company that put these numbers in. It's bankers, it's not just farmers. And I'm like, I still think there's a little fudge in there.
Yeah, so that 1.8, probably $2 a bushel, somewhere in that range. The 1.8 could be a great base rent in a flex situation. Yeah. So 270 guaranteed, and then there's an opportunity for a bonus on top of that if it's a good year. That's the way a Halderman might think about that, is using that as your base rent, and then having an opportunity for a bonus.
So you just did the calculations there, and is that a good number for 24? That was 2023 and 22, and we know that farm income was, I just read it. 2021, 2, and 3, the three highest net farm income years on record. So is 24 is it time to adjust downward? I don't think it is, but I'm going to hear you tell me why.
No, I think steady is what I said earlier, and I stand by that. So I think, yes, that rent would probably apply also to 24, because I think we're going to be steady with what 23 rents were.
Factors that influence the rent involving the condition of the land. You already spoke to size. It's 80 acres, but it's got 5 patches because the drainage ditch comes through, whatever. There's a farmability, there's a fence row, there's drainage. It's pretty darn important. Just like you've quantified, and this is going to be harder to do, you can quantify the $1.80 based on the real number, $1.80 per bushel of corn productivity, multiply that, and that's what your case rent should be for 2024. Can you give me a factor of deduct if it has, demerits? Can you say back it down to $1.40 per bushel of corn if you've got to pick up your equipment and move it twice to do that same 80 acres? There's probably a factor there, and it's a little more cloudy.
It certainly is, because it's highly variable. If it's a drainage issue, all right, well, that farm has a wet reputation. And I think reputation is a great word in this case.
You've used it
because it factors into land values as well. But how many times at a farm sale have I been there and the potential buyers might say, well, that farm has a reputation of being a wet farm.
Yeah.
Well, wet farm means that it probably has 10% of the acres that are maybe a drowned out spot, maybe the weaker spot. And so is it a 10% deduct off of that? Could be. But drainage would be a huge one. The other would be, well, I drive by it every year and the productivity just isn't there. The other quote I hear sometimes is, I've never seen a fertilizer truck across the farm. Meaning, I think the fertility is below average. And some of that can be seen in just how the crop grows and how it appears during the growing season. So fertility, weed control is another one. Yeah. Is the weed control spotless, or is it somewhat suspect? And so those things factor into reputation, and those certainly can have an impact on rent, because you can have fantastic soils and even a good farmability. It's one field. But my land, if it's got a poor drainage system, or it has poor weed control every year, a potential lessor or lessee is going to look at that and say, yeah, I'm going to discount that 10, 20% because I don't know what risk I'm getting into.
By the way, that reputation, it ties into the other aspect. If you wanted top dollar as a loaner, the people that have been driving by your property for the last 30 years might be really keen on it, or they might not be really keen on it, because they might have that whole thing. Well, I remember back in 83, and I remember back in 2014, they're going to have all this stuff that biases their reputation, their reputational aspect of your property, that might be just that, like unconfirmed bias. And then the person that's 20 miles away, hell, they haven't been driving by there for the last 30 years. They don't have that bias. They just could look at the productivity. So it's kind of, you talk about there's the advantage of the person down the road. Your higher bid that's 20 miles away might be because they're not biased, and maybe the bias has a justification. Mm-hmm. Yeah, I've never seen a fertilizer truck on that field. It's always wet in the back. You can't see that from the road. I mean, I know those things because I've been on those properties just as you have. But also, I know that we're all guilty of letting bias creep into our mind. Familiarity bias, I guess I would call it.
Yeah, no, so we're selling our farms 60% of the time to the farmer down the road.
Yeah.
So I would argue that on renting, you're probably renting it to the farmer down the road
60% of the time. Yeah.
Oh no, more than 60. Okay. I think it's even a higher percentage. You're renting it to somebody in that geographic area, so they know that farm by reputation to some degree.
Yeah.
And so that is a major factor. I point out in my real estate presentation, we had 2 sales a year, 2 months ago, November 29th of 2022. They were almost the exact same productivity index, 2 different counties. So location factors into this. They brought 100% difference in price, Damian. One brought $7,500 an acre. The other one brought $15,000 an acre. I would argue rents would be big disparity in those two. Yet the soils were almost the same. So what's the difference? Some of it was location, but some of it was absolutely reputation. One farm, the one that sold for more money, best farm in that county. The other farm didn't have the greatest reputation. Was more known as a poor farm. So I would argue that not only in land values did that show a big difference, it would also show a big difference in terms of rent.
By the way, you shared that in the September 27th webinar that I hosted with you. And I encourage you, if you are listening to this and you're geeking out on it, and I know you are, because if you're an ag person, this is a good topic. Land values, cash rent values. I've always gravitated to the money and business side of ag, hence the Business of Agriculture is my podcast. But if you want to geek out on this a little bit more, go back. You can go to Halderman. I just pulled up my phone to make sure that it was on there. He's got blogs. It's just Halderman, Halderman.com, and check out the webinar we did. We had interaction from attendees, and we talked all about values. And his description of, is it the wacky? Is it the
WAPI? Weighted Average Productivity Index. Yeah, WAPI.
Weighted Average Productivity. See, I remember this stuff. Weighted Average Productivity Index. It's a great discussion, and you can get more in depth than that. So you can go and check. And the webinars are on the Halderman website, correct?
Yes.
Yeah.
Yes, they are.
So anyway, I encourage you to do that. All right, I got more questions for Howard because it's a fascinating discussion. Before I get into that, I want to tell you about Truterra. Truterra is one of my business partners here at the Business of Agriculture. They're a subsidiary of Land O'Lakes. And Land O'Lakes looked around and said, you know what? There's these carbon markets. There's this ecosystem marketing, as we're talking about, environmental programs. Maybe we can help farmers make money. And that's what you're talking about. I just had an interview with somebody that got money from Nestle, the company that makes chocolate, is giving money to farmers for sustainability efforts, and it comes through companies like Truterra. And Truterra essentially is the conduit, if you will. Maybe you're doing cover crops, tracking your nitrogen reduction efforts, variable rate fertility, reduction in tillage. These are the kind of things that can basically give you a score on how your soil health is doing, and you can get paid. You don't have to make huge changes and all of a sudden sacrifice your yield. You're probably doing some of this stuff already if you're a progressive-minded farmer. You can go to TruterraAg.com to figure out more about this. Truterra, Truterra, TruterraAg.com. Go there and check it out. It's about economic and environmental sustainability on your farm. Talking about a skinny year, possibly in 2024. Maybe you could use some money that comes from another source. It's a revenue diversification while it's also helping your soil. TruterraAg.com. We already talked about the hybrid method that you do. Let's talk then about the rent thing. The WAPI index, again, I encourage you to go and listen to that on the Halderman, the webinar from September. When we're talking about setting rents, Howard, I just heard about a Missouri deal where a friend of mine that does farm financials, and he was shaking his head. Someone bid up the price to $475 an acre for Missouri farm ground, which seems pretty steep, even in the best of Missouri farm ground, and this was not. This was North Missouri. $475 with a 3-year commitment. That seems foolish. That seems like this farm operator is going to get over their skis if they are not already. Do you think it's wise to set rates on either side, renter, owner, 3 and 5 years where it's guaranteed? It seems like it's a recipe for disaster.
So at Halderman, we generally do a 1-year lease. We prefer the flexibility that gives a landowner. And it's really not so much about whether the rate's the right rate for a long period of time. It's more about if that landowner decides to sell the farm or do something different with it, they get a 1-year deal.
Yep.
And too many times we've seen a situation where you've got a 3-year or 5-year lease, and after year 1, they want to sell it. And that becomes a little bit of a cloud over a sale if you've got a long-term lease that's still hanging out there. So we generally do most of our leases on a 1-year lease. And I've got tenants, and I want to be absolutely clear, I've got tenants that have been on farms 20, 30 years on 20 1-year leases.
Yeah.
So it's not that we don't want a long-term relationship. It's just that we do it on 1-year leases. So 3 and 5-year leases, where we would consider them, Damian, is where maybe the tenant is making an investment in that farm alongside our landowner. So what I mean by that is we have instances where the tenant maybe pays for the irrigation. The tenant maybe pays to install the drainage tile.
Yep.
Makes that farm a better farm.
Yep.
But because they're making a capital investment in the farm and they don't own it, we want to give them a longer term lease. So it could be a 5 or a 10-year lease in those instances. And then we have a buyout clause. So if the lease is terminated after 4 years, the tenant gets bought out for some percentage of that investment they made on the front end.
Yeah.
Now, your question about the tenant's risk and a 475 lease for the next 3 years, I guess I would want to know as a landowner, the ability to pay. This is where you really do your due diligence. What's their balance sheet look like? What are they growing out there, and how do they plan to be able to pay that kind of rent? Because that seems high to me going into potentially a period of lower commodity prices.
Yeah.
So that's a question in my mind that I need to have a lot of comfort around before I would recommend a 3-year lease at that rate. Now, from a landowner's perspective, well, lock it in 475 for the next 3 years. What we know today might not be a bad deal. But the question is, do you get it paid or not?
Yeah, that's the thing. I mean, if you've been in business long enough, you've had contracts that they were worth the paper they're written on, because if you've got somebody you can't get the money out of, okay, great, I'm right, I won. I got a judgment. But if you can't get the money out of them, there's a moot point. When we talk about that thing, I like it because, remember the person that's the farmer that's listening to this says, well, that doesn't sound right, only giving them a 1-year lease. No, you can do it for 30 years. It's just that we don't want to be fixed in the situation where this way you have some flexibility on the rent. And that, I think, is the right thing. I visit rent rates with my tenant every year. And I do it based on reading all the stuff, the Purdue study, the Illinois study, the Iowa State study, interviews with guys like you, all the meetings I go to. And I think that that's the right thing to do. You obviously visit the subject every year as well.
Well, we do. And so we're managing 600 farms. So we see rental rates all over the state of Indiana, Ohio, Michigan, Illinois. So there's a tremendous amount of feedback. In fact, I do a couple of internal surveys with my team, spring and fall. And I say, what did you do for 24? That'll be the survey coming up here in March. And so I'll have all that feedback that gets shared within the company. So there's a tremendous amount of intelligence that we have within the company that allows our farm managers to make decisions and keep that rent fair. I know you maybe don't like that word, equitable, but keep it at the right rate as we go into 2025. And so, yes, we're doing it every year. Some people may say, well, that's too much work. I don't know what the rents are. Well, we do. That's our job. And so as a result, we're completely comfortable adjusting it annually. And I think that's a more fair way to do it.
When
market goes down, maybe the rent should come down some.
Well, there's no question. And that's, and I made the joke about fair, equitable, right. We all know what's right. And also, you know what? We use the word sustainable so much in agriculture, and it's being thrown at us a lot. I think that a rent arrangement for it to be sustainable, needs to be profitable on both ends. It needs to work for both parties involved. What about that thing that your managers, one of the things they do is manage that thing, which sounds a great deal more complicated to someone that's never done it, the hybrid method, if you will, the base plus bonus arrangement. That's how you guys earn your money. You guys earn your money by being boots on the ground and eyes on the property, and then also setting up those kinds of arrangements for your tenant landowners, right?
Exactly. That's our job. And so we have the calculations and the contacts to create a flex lease and to create a bonus structure that works for both parties. And there are a lot of different negotiated items in a cash flex lease. You got to negotiate the base rent. You have to negotiate the revenue trigger. So where if the revenue is over a certain hurdle, then there's a sharing. You have to negotiate the percent shared with the landowner. Is it 25%? Is it 33%? Is it 50%? And then you have to negotiate. Then you have to figure out how the pricing is done. So yield is pretty simple. It's going to be the actual yield on the farm.
Yep.
But what's the average price that you use? And maybe sometimes it's 4 months, 6 months, and sometimes it's 12 months. Which trading day of the year or the month are you using? So a lot of moving parts to negotiate. But again, that's what we do all the time.
So by the way, on that thing, just because I'm curious, we always can find out what a price is 2 months from now. Can you say here was the average soybean price over the term of from May 1 till December 1? Can you say what was the average? I'm sure somewhere that must be with all the market stuff. Yes.
Your ADM, Cargill, all your grain buying, ethanol plants, they keep a record of the cash price of the fall price they're paying.
Yep.
So let's say we have a cash flex lease and the average price is the first trading day, March through December.
Yep.
So we'll call them in December and say, all right, first trading day of these months, and we'll give them the actual days. Sometimes it might be the second or third day of the month, but It's the first trading day. And we give them the days, and they'll go back and look, and they'll say on March 1st, we were paying $5.75 per bushel for corn that would be delivered in October. And then what was it for April 1st? And what was it for May 1st? And they have all that. So, yeah, that's not hard.
So that's not hard to pull up. All right. I gave my advice, and I want you to close us out with your piece of advice to both a landowner and to a tenant. My advice was, if you are that tenant, and I'm not harshing, I'm being very frank with you. This is a business, and I told you my personal example, and I think it's wrong. If you're screwing somebody and you think you're getting away with something, don't be surprised. And then I've heard it before. Then, well, somebody came and door knocked me, and drove that rent up. I'm like, they put it where it should have been. You sorry ass. You were screwing somebody, and you know it. And usually, the people they're screwing are people that are a little more vulnerable, a little less knowledgeable, a little more less hands-on, maybe older, etc. So if you're screwing somebody and you know you are, or you don't admit you are, my recommendation is, we all know what the real numbers could be. Howard just shared all the methodology to go and ascertain the right numbers, do the right thing. My advice to the tenant, my advice to the landowner, I think this is it's an asset. And while it might be a little bit of a passive asset, I look at it like, don't you talk to the people that manage your 401k? And I think this is something you should be actively involved with, keeping up with, listening to stuff like this right here. And so those are my two pieces of advice. Your piece of advice for the tenant and the landlord, because you see it from a different perspective.
My advice for a farmer, if they want to grow their farmed acreage over time, is it needs to be two components. One is paying a fair rent to those landowners you're working with. And you can use the Purdue numbers to kind of give you a barometer. You can delve into cash flex leases. I'm pretty transparent, Damian.
And incidentally, we use Purdue because we went there. But remember, every state has this. South Dakota State University probably has numbers somewhere.
All land grants.
Yeah, any land. If you are in agriculture, you have a land grant school in your state. It's available. I'm sure in Alabama you can pull this up from the University of Auburn. Probably has this.
Yes. So there's ways you can get that information, and be transparent with your landlord and talk with them about, well, I want to pay you X amount of rent, and it's fair because of these factors. Or I want to do a cash flex lease, and I've seen how Halderman calculate. Here's how I want to propose calculating it, right, and I'm going to pay you a bonus if it's a good year. You're exactly right about the door knock situation. Go back to Freedom to Farm, and I know there's listeners here that don't recall 1995, but all of a sudden there was $50 an acre of a government program payment with no strings attached. And so we heard about farms that changed hands because somebody walked up to the landowner and said, whatever you're getting today, I'll pay you $25 an acre more. And so those sorts of situations sometimes occur. And how do you prevent it? Well, making sure that your rent that you're paying is fair. It doesn't have to be top dollar, but it certainly needs to be representative of fair market today. And so there's a lot of ways you can capture that. From a landowner's perspective, you're exactly right, Damian. You want to manage that asset because a farm today, a 240-acre farm, which is the average farm size we manage, is worth probably between $2 and $3 million today in the Eastern Corn Belt.
Sure.
That's a significant investment.
Yeah.
You say, well, it's 200 acres and I grew up on it, and I just do whatever dad did.
Yeah.
It's a $2 to $3 million investment. And that's a lot of money to you and me. So I think that's something that I want to have managed well. And whether it's Halderman or somebody else, if you live in New York, you have a farm in Indiana, and maybe you're not up to date on what the rent terms should be or how to do cash flex leasing, there are resources out there that can easily generate a higher return on investment for you, take good care of the farmer, and more than pay the fee that you would pay to that manager to do it.
I think, speaking of the management and to that person that is the landowner, it's passive and it's maybe too passive. there's the other component of it. If you want that to continue to be a good asset, there's the drainage that you need to continue to make sure is done right. There's the fence rows. There's the to make sure that it doesn't become that place that nobody will pay top dollar for because it's grown in, it's not been cared for, it's been mistreated. Those are the kind of things also that I think matter. That would be my recommendation to the land owner is you want to continue to keep this asset. This doesn't happen just by luck, right?
Exactly.
The part where you actually use...
As I said earlier, it's the return on a farm is no different than stocks. You have a cash return and you have a value enhancement over time. Yep. And you want to have the best house on the block. So how you fix drainage, how you maintain fertility, how you have weed control, how you clear fence rows and make it easier to farm, all of those things factor into that reputation and enhance the value of the farm comparatively to other farms in the area.
I think we're going to leave it right there. That's really good stuff. His name is Howard Halderman. I already held up my phone. If you're watching, which I hope you do watch, remember I've got a YouTube channel. It's Damian Mason. Just type on YouTube, Damian Mason. It's free. I'd like you to subscribe. Also, my shows are available on Acres TV, the streaming platform that the Hefty Boys created. And you can watch it there. You can also listen to it wherever you get your audio podcast, Spotify, Apple. I mean, all those places. It's there. His name's Howard Halderman. I do encourage you to go to their website and dig up that webinar that we had. If you like this topic, we recorded it on September 27th. Every quarter, I'm hosting their webinars. Our next one is March 5th on Tuesday, so go ahead and mark your calendar on March 5th. We're going to be talking about 1031 exchanges. We're going to be talking a little bit more about marketplace activity. Howard's going to use his expertise, and also coming off of the winter season of all the sales and transactions. So he's going to do the update on the marketplace, update on rents. You've got all that stuff. You're going to have another month's worth of crap in your head between now and then.
Exactly. We got more sales to do, Damian.
Yeah.
We got more data points.
And then we're going to have on a guest from a 1031 tax-deferred exchange company that's going to be on there. So it's going to be great stuff. So it's a good series, that the webinar that they're doing over there, and they've got a good panel of experts if you are interested in these kind of topics about land ownership. So thanks for being here. Until next time, go and check out my past 330 episodes of the Business of Agriculture. Go and check out the Halderman website to see the blogs and also the webinars that we've done there. And thanks for being here, Howard. I appreciate it. Good to talk as usual.
Thank you for the opportunity, as always.
Betcha. Until next time, thanks for being here. I'm Damian Mason, and this is the Business of Agriculture. Hey, thanks for being here. This episode of the Business of Agriculture was brought to you by Pattern Ag. You've heard me talk about Pattern Ag because I think it's a pretty cool concept. New technology that allows you to predict the problems you're going to have and therefore treat them before those problems cost you money. What kind of problems am I talking about? Pests and disease. Things like cordon rootworm, sudden death syndrome, cyst nematode, and a whole bunch of other bad things that happen out there in the field that can cost you money. Guess what? Pattern Ag will let you find out ahead of time if the disease or the pest pressure is there, and therefore you're treating it before it costs you any money. What a great concept. Go to pattern.ag, that's www.pattern.ag, to learn more about their product, their technology, how it can make you money, save you yield, and also where you can find a rep that can come out there and do the work for you. Pattern.ag.